Hello, everyone. I hope everybody is good today. Today I was late for 5 minutes. I'm very sorry for that. And now, last time I gave you the activity to do, it was the activity that you have to transfer the data into the Excel spreadsheet from the comprehensive example. So I want to go again over it just quickly and just move to the topic. And apart from that, just wanted to tell you, okay, I'll tell you the later, like after the class. But concerning the final exam, sorry, the midterm one, you will have it on 14th of October. You're gonna have it on 14th of October. Okay, this is what you have to take the notes. Just a second, let me just. Yeah, it's 14th of October. I'm gonna put this announcement in the Moodle, and so that you can follow everything. So what will be included, what will not be included, everything will be available in the Moodle. And as well, I'm gonna tell you before. Like on Wednesday, I'm gonna give you more details about it. What chapters that you will be responsible, what materials that you will be responsible for. Okay, let me share the screen with you. Okay. Okay, this was the comprehensive example that we worked. Actually, we didn't work, but I let you to work on your own, and you try to stimulate the same spreadsheet using these numbers. And some of you face a big problems for doing this, and I'm gonna go over it like step by step. So what I did here, first of all, you need to find out everything. What is the fixed capital investment? What is the net working capital investment, and so on? Is everything the similar and the easy, but with some exception. The exception that they have got the cumulative net working capital investments. Okay, this is how they get this one. This is made you to a bit complicated. Now, talking about first, the fixed capital investment is 2 million. The project has expected 6 years. Okay, expected 6 years. So as you can see here, like from 0 to 6 years. And the initial investment in net working capital was 200,000. And at the end of each year, the net working capital must be increased so that the cumulative investment in net working capital is 1/6 of the next year's projected cash flow. So every year, your cumulative, so our net working capital investment is 200,000, and it says your cumulative investment in net working capital should increase every year so that it will be 1/5 of the next year projected sale. Okay, cumulative with me, which means that you accumulate all the in net working capital. Now let's do it. I have fixed capital investment. I have net working capital investment. So it's 2,200,000. I'm gonna dollarize it. And of course, this net working capital is like cumulative one. And we have got sales here. We've got the sales. We've got the fixed cash expenses. And variable cash expenses, war cash expenses. And we have depreciation. So these things are given. These things are given, but one thing, just create one row for the number of the years. These things are given. So 1, 3, 4, 5, 6. So 6 years. Okay. And sales Let me see. Let me get the data from sales. Look what it says. The initial investment and so on. The fixed capital is depreciated by 30% in year one, and so it gives you the depreciation amount. Okay, it's from the fixed capital. Sales are 1,200 in 1 year. It grow by 25% rate next 2 years, and then grow by 10% for the last 3 years. So on fixed cash operating expenses is 150 for 1 year, for the years from 1 to the 3rd, and 130 for the years from 4 to 6. And variable cash operating expenses are 40% of sales, and 39% of sales in year 2, and 38% in the remaining years. Then low town marginal tax rate is 30. So we're just gonna put this. Let's start with the depreciation. Let's start with the depreciation, like 30%. Depreciation is the first year. 35%. Let me just copy it like this so that we just don't move. Let me get this info. Paste it here. Okay. Now, my sales, I'll start with sales. My sales is 1,200 in year 1. Okay. And in year 2, it says they will grow 25% rate for the next 2 years. So for the next 2 years, that will grow by 25%. So this times by 1.25. This times, this times by 1.25. And it says that it will grow at 10% annual rate for the last 3 years. For the last 3 years, it will go at 10%. This times by 1.10. Okay, this is how it works. Okay, fix. Okay, I will come to this part. These are the very easy. Let me just put it quickly. So when we come to the fixed cash expenses, it directly says that fixed cash expenses are 150,000 for the years from 1 to 3, and 130,000 for the years for the last 3 years. So first 3 years is 150,000, and for the last 3 years 130. And variable cash expense, it varies with the sales. It says that it's 40% in year 1, 39% in year 2, and 38% in the last 4 years. In the last, with the range of 3.6 here. Okay, variable cash expenses. So 40% of sales, then 0.39 of sales, and for the last, it changes with variable cost, and as you can see, it's 38%. 0.38 times this. And depreciation is given as well. Depreciation, it says here. Where is it? Here. Fixed capital is depreciated 30% in year 1, 35% in year 2, 20% in year 3. And as it seems that it goes with the modified accelerated recovery system depreciation. So 30% of this. Then we move in year 2, 0.35. In year 3, and it's 10%.
%5.
5%. And at the end we have 0. So the accumulation should give you the total amount, the depreciated value. So what we do here, so we calculated everything. Now I said the important part is this one. It's a cumulative net working capital. 1/6 of the cumulative investment in net working capital of the next year's projected cash flow. So 1/6. So what I do here, just make it like this: 1/6. Okay. So 1/6 times next projected cash flow, and as it's been cumulative, we should subtract for this current year, and we should subtract the remaining net working capital, which is this 200 minus 200, which is 50. And we do the same thing for the rest, like this times next projected cash flow minus already existing the net working capital, like year 0 and year 1. Oops, doesn't work so. Let me fix this one. We can do the same thing here. This times next projected cash flow minus this minus this. We're subtracting the cumulative net working capital. And if you, oops, it doesn't work like this. Then I need to manipulate, but I don't want to waste the time on that. So this times next projected cash flow minus this, minus this, minus this, and minus this. And the last one, this times next projected cash flow, and minus all. Okay, so this is what we get as a cumulative value. This is what we get as a cumulative value. Now we constructed the income statement for cash flow projection. Now we need to calculate the operating income before the tax, or we call as EBT, earnings before tax. EBT. But one thing you should keep in mind, these are the investment costs, okay? These are the negative ones. So from sales, we subtract this, subtract this, subtract this to get the EBIT, okay? And we do the same for all. We don't touch it, okay? This net working capital investment now, we don't touch it. Then we need to do the next step, add back the depreciation. So we're adding back the depreciation amount as the depreciation being, but no, sorry, sir, we just forgot to make the taxation. We need the deduction of the tax. So which is, tax is 30%, the marginal tax rate is 30%. So 0.30 times this. Okay. And we will get operating income after tax. And we adding back the depreciation amount. This is what we all know. Operating income after tax is equal to this. This is what we have it. Now we need to work out on, so let's see what's going to happen here. The Lautan will sell its fixed capital investment for 150,000 when the project terminates, and they recapture its cumulative investment in net working capital. So we need to take into consideration the net investment. So total after-tax cash flow, but the terminal value should be equal to. So we need to find terminal non-operating cash flow. So we're selling for 150,000 minus the tax amount. So 150 times 0.30. This is what we get it. And of course, the cumulative of net working capital. We should get the cumulative value of net working capital. Plus, we're adding the net working capital, if you remember from the previous cases. So I'm just going to sum it up, sum all. Okay. So we're adding to the terminal non-operating cash flow the cumulative value. So this is terminal non-operating cash flow. Now we need to find total operating cash flow after tax. Basically, what we used to do is to bring down all the expenses. So all expenses are here. So put the minus, bring it. So this plus this. So this is my investment cost, 2,200,000. I'm bringing the cash flow after tax, this minus the net working capital expense till I reach this one. And when it comes to here, minus this. So there's some mistake I made it here. Never mind why I'm minusing it here. It shouldn't be minus because it's a terminal non-operating cash flow. Okay. So I'm just by automatically put the plus here because I was making the minus here. And I need to, the terminal operating cash flow, we are always adding to the total operating cash flows. But when it comes to the net working capital, we need to subtract from operational income after tax to derive the total operating cash flow after tax. So this is what we get it.
I'm sorry, could you show TNOCF formula
Yeah, of course. Okay, sure. This is for how much we sell it. Look, it says that Lautan will sell its fixed capital investment for 150,000. Okay, we're selling for 150. And once you're selling, you're making a gain, you're making profit on that, you have to tax it. And we're taxing this amount. We're taxing it, okay? We're taxing. And this amount that is taxed should be deducted. So we pay the tax on that. Plus, we are adding all the net working capital because we had the cumulative net working capitals and we need to add it back to at the terminational date. So we're adding back to get the terminal non-operating cash flow. And the last stage, what we do here, terminal non-operating cash flow plus operational income after tax. That will give you total operating cash flow after the tax. So now we can calculate the NPV with the discount rate of 12%. select the value, plus. So this is our NPV, and IRR is equal to 27, like 26 and 6 if you just make the numbers. Okay. Now we can compare. We can see that we do accept the project. The project is profitable, as our NPV says, and IRR confirms, IRR supports the NPV decision because the rate of return is greater than required rate of return, greater than the opportunity cost of capital. Okay, this was the example, like a comprehensive example. I'm gonna save it, okay, and upload it to the Moodle so you can access anytime you want. If you have any questions, please feel free to ask it. If you don't have any questions, please let me move to another subject. Now, last time we talked about capital rationing. We said the capital rationing has been divided into two parts, like hard capital rationing and soft capital rationing. Hard capital rationing occurs when funds are allocated to managers under capital budget, and this cannot be increased at any circumstance. So whatever the money you're given, you have to use that money. So you have to make your decision based on the budget that you're given. And when it comes to the soft capital rationing, it occurs when the managers are allowed to increase, allowed to make some changes in the allocated budget if they have a capacity, if they have a capability to justify their changes in their budget. And that justification should be done to the senior managers. Risk analysis. Risk analysis has got three parts: sensitivity analysis, scenario analysis, and simulation analysis. Sensitivity analysis, it involves the examining the effect of NPV changes in one certain input of the variables at any time. So you change one variable, and what will be your input? So by variable, I mean you have sales. These are the variables, okay? You have, let's say, 4 variables. What if you change one variable? What will happen to your NPV? Let's make your sales to increase to 1,500. Look, your NPV changed, as you can see it. Just one sale changed. What if fixed cash expense changed? What if variable cash expense changed? What if depreciation changes? What will happen to your NPV? Like you're trying to measure the sensitivity of NPV to changes of the variable, how the NPV is sensitive. So by this, as a financial manager, you will know what variable you should play with more in order to come up with certain decision to increase or decrease the variable. Maybe changing the fixed cash expenses doesn't change a lot your NPV. Maybe your NPV is more sensitive, highly sensitive to sales. So you have to determine which factor and which variable are more exposed to sensitivity of NPV. So this is why we are using sensitivity analysis. Scenario analysis, it involves the examining of the effect of NPV on the set of the changes that reflect the scenario. So we create different scenarios like recession and normal condition of economy, and when there is economy boom, okay? Like 3 scenarios. So in a recession time, what will happen to your NPV? In a normal condition, what will happen to your NPV if there is a boom? So you're creating different scenarios. And based on these different scenarios, you are coming up with a certain decision whether you should accept the NPV or not. This is how it works. Okay. And like this is one scenario, okay? This is one scenario. This is one scenario. Then another scenario, when your sales are high, when your expenses are low, and what will be your NPV? When there is a recession, worst case scenario, like sales are low, the expenses are high, so you're trying to exaggerate the things, like you're making your profit low and expenses high in order to see what would be the worst scenario. You're trying to create the most or the worst scenario that could you ever face, actually. This is called a scenario analysis. When it comes to simulation analysis, like Monte Carlo analysis, it involves examining the effect of NPV when all uncertain inputs follow their respective probability distributions. So with a large number of simulation, we can determine distribution of NPV. So we're trying to, okay, in here, at least we're trying to predict, okay, we're trying to predict our NPV. We're trying to predict our NPV with the certain sales, with a certain fixed cost, with a certain variable cost and depreciation. However, when we do the Monte Carlo analysis, we do some manipulation. This sales all the time changes. Like in year one is this, in year two, so we never know what would happen in year two and third. So we put some command, some function, so it will change every time you click enter. So every time you click, you just press enter, it will change the sales for all years. It will change the cost for all years. It will change the depreciation and so on. And in this way, what will be your NPV? And we will do this 10,000 times, 100,000 times, and so on. And with this, we will be able to see what is your distribution of your NPV. Like what will be the most highest NPV and what will be the least lowest NPV. This is how we can do the Monte Carlo analysis. And with this risk analysis, it will help us to come up with a certain decision whether we should accept the project or not. Okay, here's some given example of the sensitivity analysis, but I want to stop here. Sensitivity example, I will do it on Wednesday. But for you, I want you to go to the book. Go to the book, this corporate finance practical approach. Okay, go to that book. The page is 134. Okay. I'm giving you now activity number 3. Activity number 3. But this activity, you have to do it by your own now. From problems 1 till question 10. So here's the questions. You have in time 45 minutes. Yeah, 45 minutes. Yeah, 45 minutes. If I'm not mistaken, if my watch. Okay. So go to the Moodle if you didn't download before, download it and start solving it. Solve it on your using the Excel. I'm gonna create the link where you upload this solved problem. Okay, activity number 4. Sorry, I'm very sorry, mistakenly. Activity number 3. Activity number 3, which will be available now in the Moodle. So try to solve it now from 1 to 10. From 1 to 10.
Okay.
Okay, I'm here. If you have any questions, please feel free to ask. But I will stop sharing. You should download the book, and I will create the link in the Moodle. And by the way, the first exam will be similar to these multiple choices. These are the multiple choices, okay? It will be similar to this. And everybody will have its own questions. The questions will be sequential order. So if you have to solve, if you solve it, you cannot return back. So we'll practice it more on this type of questions. Please solve it now and submit it. And before you do it, I want to take the attendance because I was asked to take attendance. I was asked to take the attendance by the name, who is present, who is not, because it's like obligation by the dean office. It has been said that we need to take every time we meet the attendance. Okay, Sanjar is here.
Yes, I'm here.
Okay, Islam.
I'm here. I'm here.
You know, the best thing, just type it, okay? If you're here, type it in chat. Aiday.
I'm here.
Just type it. Type it. Yasmin. Yasmin. Okay. Jean. Aman geldi Jean. Okay.
Here.
Okay. Don't type it unless you have not been called. Nias. Tomiris is here. Nias is not. Yerzat. Gabdul Gani. Okay. Raushan. Raushan, not here. Binura. Aidana. Buranbayeva. Okay. Begzat Daurianov. Begzat. Okay, not here. Zirui. One. Sultan. Kanapia. Sultan. Not here. Daujan. Daujan. Here. Eldar Kasyanov. Here. Aydos. Okay. Gani. Gani here. Okay. Artur Moon. Artur. Gazis. Baglan. Zarina. Abdul Hakim. Sorry, Abdul Rahim. I'm very sorry, Abdul Rahim. Okay, here. Abdul Rahim here. Raihan Sadvakasova. Here. Alibek. Daniyar. Sanjana. Okay, Sanjana here. Dalir Khan. Dalir Khan. Baglan Kleshov.
The
Okay.
Lirham is here.
Milana.
Sorry, Dalirhan is here.
Okay, Dalirhan is here. Baglan Kleshov here. Okay. Milana here. Arnur. Ilya. Ilya Tsoy. Here. Daniel. Vladislav. Umarov is here. Diana Uralova. Clementi. Okay. Janelle. Camila. Camila Yusupova. And Adilhan Jamat. Okay. Now you can start doing it. While you're doing it, I'm going to upload it